The world's inflation outlook hangs on a 21-mile-wide waterway. What happens in the Strait of Hormuz could decide the Fed's next big move. Here's why you should care right now. The Strait of Hormuz is a critical choke point for global oil supply. Roughly 20% of the world's oil exports transit this narrow passage every day. Any disruption here can sharply increase oil prices, which then ripple through fuel, shipping, and manufacturing costs worldwide. This makes Hormuz a key factor in inflation forecasts for economies heavily reliant on oil imports, including the U.S. The Federal Reserve watches these developments closely because rising oil prices tend to push inflation higher, affecting their monetary policy decisions. In recent months, geopolitical tensions around the Strait of Hormuz have heightened, causing oil prices to increase by approximately 15% this quarter alone. This surge directly threatens to push inflation above the Federal Reserve's 2% target. Economists and analysts at Barron's highlight that this volatility injects uncertainty into inflation forecasts. Since energy costs feed into nearly every sector, the Fed's inflation models must now factor in a potential prolonged supply squeeze, which could force the Fed to rethink interest rate hikes or cuts. Federal Reserve officials have indicated that the situation in Hormuz is a significant variable in their upcoming policy meetings. If oil-driven inflation spikes persist, the Fed may consider accelerating interest rate hikes to keep inflation in check. However, if disruptions cause economic uncertainty or slow growth, they might pause or reverse tightening. This balancing act underscores how much the Fed's next moves depend on developments in this strategic waterway, making Hormuz a focal point for investors and consumers alike. Higher oil prices resulting from instability in Hormuz impact everyday consumers through increased gasoline and heating costs. Manufacturers face higher input costs, which often translate into pricier goods. On a broader scale, global markets become more volatile as traders react to the risk of supply disruptions. Countries reliant on oil imports are particularly vulnerable, and inflation pressures in major economies like the U.S. can ripple worldwide, affecting jobs and purchasing power. Given the tight link between Hormuz and oil prices, markets are bracing for continued volatility. If tensions escalate, oil prices could spike further, pushing inflation higher and forcing the Fed's hand on interest rates. Conversely, if diplomatic efforts ease the situation, prices may stabilize, allowing for a more gradual policy approach. Investors and consumers should watch developments closely, as these dynamics will shape economic conditions and financial markets for months to come. What does this mean for you? Keep an eye on oil price trends and Federal Reserve communications. Rising oil prices can increase your fuel and heating bills, and Fed rate changes can affect mortgage, credit card, and loan interest rates. Being aware allows you to plan budgets and financial decisions more effectively. Staying informed on Hormuz-related news is more important than ever as it could impact your wallet directly in the near future. The Strait of Hormuz is no distant geopolitical issue. It's a key driver of price changes that affect your daily life. Oil flows through this narrow passage, influencing inflation and the Fed's decisions on interest rates. Understanding these connections helps you anticipate changes in fuel costs and borrowing rates. Stay tuned for updates and subscribe to Daily Q&A for clear, urgent explanations on how global events impact your finances.